Nation. I'm doing well, Tom. Everybody, welcome in. Hit the like button on your way in the door. Tom, how are you, man?
I'm good. I'm good. I had kind of a chill weekend, and I'm actually I'm actually got a lot of energy tonight, and I'm not sure what I'm going to do. I don't know if I'm going to trade.
Big week
I'm not
coming up
sure
in
what.
the city of Chicago.
I know.
Big
I
week.
know. I know. I'm kind of excited about it. I'm only going to be here for about half the week, and so because I had a commitment to the second half of the week, so I'm not sure. But I mean, in spite of what everybody says, or despite of what everybody says, I'm going downtown tomorrow, and I'm going to try to make it into the office. I don't think there's going to be any issues at all.
Brave man. I hope so too. I hope so too, my friend. You want to get right into it? There's a lot to
Sure.
talk about this week.
Sure. Let's do it.
Okay. Monster week. I don't know. Can I say monster week when the Nasdaq is up 5%, S&P up 4%? I think Russell up 3%, something like this. I guess relative to previous week expectations, pretty decent week. What was your thought?
Well, you can definitely say monster week because the reality is we've been up for, I believe it's 7 straight days.
Right.
I can tell you in 1 second, but I think it's been. Let's take a look here. 1, 2, 3, 4, 5, 6, 7 straight days. You don't get a lot of. I mean, you might occasionally. We can go back to when is it? Early May. We had 7 straight up days, and then we've had other times where we've had, 8 out of 10 and 9 out of 11, those kind of things. But every time you get the 7 straight up days, you tend to go sideways for a little bit, and then the market decides what it wants to do. Does it want to go back down and maybe scare the children again, or just rest for a little bit and then go higher? I mean, no question about it. Yesterday, I mean, last week when they sucked the vol out of the market, and they really did suck the vol out of the market. I mean, they also took the air out of, they took the legs out of the bears. They just, anything they had left, if they had any legs left, it's gone.
I agree with that. I thought, I had said maybe a week or two ago that we would see lower vol, but I thought we'd see a higher range, something above the historical range in volatility. So at 15 VIX, I got to be honest, man, that surprises me. How do you think about 1480 VIX?
How do I think about 1480 VIX?
Does that make sense to you?
It totally makes sense to me, but because nowadays things move so much, so fast, it absolutely makes sense to me. I'm fascinated, A, by the velocity of the way things move nowadays, and B, I'm not going to rule out anything. Like, I think you can rule out 12 or 13 VIX just because we've got an election coming up, if nothing else. Like, we got an election coming up. So I think you can rule out 12 or 13, which means at the current levels, if you're talking about VIX futures at 1540, and you're talking about, what'd you say VIX was? 13? What
I got it at 1480.
1480, and the futures are 1480. Yeah, I don't think there's much. I don't think there's that much more downside in volatility here. I think last week was, I mean, I don't think it was a crush, and
Monster crush.
I think you can not necessarily get long volatility here, but I think, because I don't like that play as much as I do, think you can trade the market from the short side this week, and you're going to get, not that we're necessarily going down, but that you're going to get really good pot odds this week, because I don't think you're going to see a 10% or a 15% or even a 5% contraction in volatility this week. So I think you're getting paid really good pot odds to get a little bit short here. That's it.
I agree with that. You had said, I had asked you last week what you thought about SMH, which had a decent week.
Yeah, it had a good week.
It was stable last week. Excuse me. This week it was up 9%. It was one of the strongest industries. That obviously makes sense when you get the Nasdaq up 5%. You were neutral, I think, going into last week. You've now got some relative strength at 250 in SMH. What do you think about semiconductors? Have they immediately become a little bit too expensive in your mind?
Yeah. I think I got a little short Nvidia on Thursday and Friday. I thought at around 120 it was a really good short. At 124 and a half, I love the short side of the semis this week. So speaking of pot odds, and I just sold some futures actually right here. But speaking of pot odds, uh, if you like the pot, I mean, if you're like me and you think the pot odds to the downside of the market are pretty good here because there's not much more downside for volatility, then you're going to love getting short some of the semis here for a trade because they got a much higher beta. And, if you think of where basically NVIDIA kind of led this market down and NVIDIA has led this market back up. I didn't think we were getting back to, 124. I was
Instantly.
kicking myself because I was short some 120 calls and I was like so mad that I covered them. And then we closed an expiration, 124. And I'm like, oh, thank God I covered them.
Yeah.
you know,
I'm going to give you
yeah,
a chance to gloat a little bit. There was obviously the big news story last week, and the big focus, I think, at least from the macro crowd, was around CPI. Ended up being a huge nothing burger. A little bit of market reaction. You could make a case a day late on Thursday.
yeah.
What was your opinion of all the hoopla on Wednesday and the eventual nothing burger
I don't, I don't,
being?
I don't get into any of that. I don't. It doesn't even register in my brain. Um, I'm. It's impossible for me to register economic numbers as having some meaningful consequence with respect to market outcomes. So I market direction. So I don't talk about it. I don't play it. I don't think in 13 years or 14 years on Tasty we've mentioned how economic numbers influence the way we trade. I just think again we're getting to the point where I really like the risk reward here of the downside. I might be a little early. I thought we could get to 5,600, and you know what? We're pretty damn close.
We are very close. 55.90. We open up here, up about a
Yeah,
1/4% in the S&P, 1/3% in the Nasdaq.
yeah.
Same thing, same picture in the Russell. Um, the second highest performing, or one of the highest performing, assets in my industry list was the gold miners, Tom. And it's been a really long time since anybody cared about gold miners, but gold has stuck up here at 2,500 quietly. Things like Barrick, Newmont, and some of the junior miners have started to rally. What do you think about gold and miners here? Is it even on your radar? Do you like the idea of either trading with the trend, probably not, or contrarian?
I have positions on in GLD, GDX, and GDXJ. So the gold miners and the junior miners. Their positions are really small because I don't think those underlyings are really that liquid, and I don't think they're great trading vehicles. I also have positions on in gold and silver, the actual commodities themselves. So I'm trading all five of those products. I'm staying small in all of them because I don't think any of them are worthy of a big shot. I think they're all just a very nice, non-correlated, high volatility, relatively liquid. GC is relatively liquid. I should throw copper in there as well. Copper too. Copper and GC are relatively liquid. GLD is okay. GDX, GDXJ, and SI are all kind of crappy as trading vehicles. So I don't think it doesn't matter if you're bullish or bearish on precious metals. I don't think it's I don't necessarily think it's a worthy commitment to very much other than a very small percent of your capital. So for me, it's just a non-correlated, diversification, and it doesn't mean anything. I'm playing them all kind of range bound, high volatility range bound plays. I don't have an opinion. If you're asking me, am I bearish on gold or bullish on gold? I'm not.
The For the early part of the week, for the whole week, Russell and Nasdaq spread did not perform, but post CPI Thursday and Friday, you actually did get a little bit of outperformance in the Russell relative to the Nasdaq on Thursday and
Yeah,
Friday, if I'm not mistaken.
a little tiny. You got a really nice move in the Russell on Thursday. You got an okay
Yep.
move on Friday, but the S&P's moved up so much that you had to have the perfect ratio on. And I've basically gone to 1 to 1 here because I'm a little bit more bearish. And I want to get short some static deltas here. So so it wasn't a winner for me, but I will say that I do think it's a very attractive trade here. I don't think what you saw in the Russell a couple of weeks ago was a fluke. I think what you saw in the Russell a couple of weeks ago when it went from like unchanged on the year, or up 2%, up 10 or 12%. I don't think that was a fluke at all. I think it was a precursor to what's coming in the last quarter of this year. And I think that smart, diversified traders will be long Russell and short everything else. I think it makes the most sense. Where we are right now, again, with volatility as cheap as it is, I like the Russell S&P trade as a pairs trade, or the Russell.
Why S&P instead of NASDAQ?
There's no reason. It's a cleaner hedge. That's the only reason. Because when you trade S&Ps and you trade Russell, you're getting $50 a point. So it's the same. Or if you're doing the micros, it's $5 a point. So it's very easy to calculate. So it's easier. I think people get a little confused when they do NASDAQ, because the NASDAQ index is huge. It's a $20,000 index. The $400,000, you have to multiply 20,000 times
it's
20.
5 to 2. It's 5 to 2. So it's 5 Russells for 2 short NASDAQ. Or you can do the micros as well. I think most people probably want to look at the micros.
Well, either way, it's the same. So vol adjusted is 5 to 2, but people have a harder time. Like, I think in general, the NASDAQ's a $400,000 product right now. And so if you're looking at the, if you're doing something that's 1/10 the size, you're talking about something that is 40,000, and it's just a huge, it's a huge product. And so when you start to think about it, and the Russell is a $100,000 product, so it's 4 times the size right now, and the volatilities have, they fluctuate, so it's even greater than 5 to 2. I mean, it's literally a 4, it's a 4 to 1 just on notional, and then you can make whatever vol adjustment. So you could say 3 to 1 to be a little bit on the, give yourself maybe a little bit more bearish. But I don't know, Vic. It's the kind of thing where I think it's at one of the more extreme price levels, not as extreme as we've had it before, but I don't think that it was a fluke a couple of weeks ago, and I think you're going to see more of that in the last quarter of this year.
I tend to agree. I've been leaning long. It's a tough trade, but I've been leaning long. I've been using the Russell NASDAQ. That's what we've been talking about on our show. I tend to agree as well. I think the only way that doesn't happen is if you get correlation to one market. I don't say that's the only way. I think correlation to one market is the obvious outlier, and where that go wrong.
You're not gonna. I don't think you're gonna get correlation to one anyway. Not in that pair. It hasn't really been much over 70 or 80 for like years. I don't think you're going any higher than that. So I think that's a pretty safe bet that that's not going to happen. I just think we've reached a very for aggressive traders here, we have had a very nice retracement. From 5,200 to 5,600 is not. It's a significant retracement off that. It looked like we were going to hell in a handbasket, and next thing you know, we're back 400 points higher without a sell-off after 7 straight up days. I know that statistically, an 8th straight up day doesn't, still 50-50, but the reality is that when you think about 8 straight up days, it happens 16 100ths of a time.
Mm-hmm.
It's not something that statistically on a 50-50 bet is going to happen very often. So I just I like the risk reward here to the downside. I don't know if you're going to get paid buying premium, but you might get paid with some static deltas, especially too. This coming week is a 5-week expiration cycle, and 5-week expiration cycles, with political conventions on the table and everything else, you tend to get a lot of whippy tape action. Like, you're up 20, down 20, unchanged, that kind of thing. I think it's going to be a good trader's market this week.
Let me ask you a fun question. Don't poo-poo it. Try to engage with it, okay?
Okay.
On Twitter right now, there's this Goldman report floating around, okay? On Wednesday, there's going to be this preliminary estimate of benchmark revisions to non-farm payrolls. It's a big thing. It's a big phrase, but here's all it means. Is that we've been getting this weird thing where you get headline numbers and non-farm payrolls, lots of jobs, and then it gets revised lower, and then it gets revised lower again. So what's potentially going to happen on Wednesday is you're going to get a big revision to the the actual labor market, and Goldman is thinking that this could be lowering it by 600,000 to up to 1 million jobs, which would tell a very different picture of the labor market. And when I thought about it, the knee-jerk reaction was, "Oh no, bearish. We're in a recession. Nobody knew about it." Then I'm like, well, if let's say the labor market is 1 million jobs weaker than the market thinks, whatever this data said, would that mean we technically have already gone through a difficult period? Now we're just truing it up and we're getting ready for cuts anyway. So why would that matter? And so I'm curious because people are going to be talking about this week. What does Tom Sosnoff have to say? Does it even matter, or do you lean one way or the other?
No,
and why not?
no, it's absolutely, this is one of the most ridiculous topics we could ever bring up on the show. And this is the kind of topic that I leave for like you and Ilya and Chris to debate. We will never touch this. And I'll tell you why. Because, and this is what drives me crazy about even anybody like, some idiot on Twitter writing about this, or some, first of all, Goldman's not going to leak what they're talking about, but just the whole point of the whole reason this is so ridiculous is if I gave you that number, forget about Goldman's report. If I gave you the actual number right now and said, oh yeah, there's a million fewer jobs. Okay.
Mm-hmm.
You don't even know what you would do. So how does it have any value? Like it's ridiculous. Like if I gave you tomorrow's newspaper today, you can make money because you could look at it and say, oh, Nvidia will be down $4. Meta will be up $4. I could buy Meta. I could sell Nvidia. I have the closing prices. Okay, I can do that. Anybody can do that. But if I gave you some economic number that's coming out in the middle of the week and it's going to be a revision to something else, it doesn't mean a damn thing. Nobody knows how it's going to interpret it. Nobody. If you put that number out in the middle of the bond pit, they wouldn't know how to interpret it. So why would you debate something that you wouldn't know what to do with, even if you had the number ahead of time? Like it doesn't mean anything. That's what bugs me about it.
Fair enough. I think it's important to address it though, Tom, to give
Really?
Tasty's point of view on something that has people.
I think that you guys can address it, but for me, it's what turns me off to traditional financial media because it's not something that you can't apply it in any way. There's nothing you can do with it. So how is it important? Like for me, if you can't apply it in some way, if it's not practical, if it can't be somehow facilitated or can't apply some strategy to it, who cares? Like why is that even that's a part of a bigger macroeconomic story, and that's for financial media to chew on because they need advertising dollars. But for retail investors that are trying to use a strategy to do something with, you wouldn't know what to do with it if you had it. You know what?
Enough.
If the Fed wants, I got an idea. You want to hear my latest? I didn't think of this before. I wish I had. The Fed, not the Fed, but the U.S. government should come out. We need to raise capital anyway. We've got a big deficit. We should say anybody that wants to buy the numbers that are about to come out, we'll sell them to you. Just put a price. It's $100. Anybody in the world can buy the numbers ahead of time for $100. They probably will make, I don't know, a few tens of millions of dollars for every single economic number that comes out. And not a single person will know what to do with it. It's free money.
Fair enough. Nancy Pelosi will be first in line. You ready to have Pete on?
The reason people trade is because Nancy Pelosi trades, which is a good thing. Okay, I don't want to get in this argument.
I'm not doing it. Yeah, we're not doing it.
I want all the Nancy Pelosi's of the world to trade. No. Pete, how are you?
Gentlemen, I'm doing great. All right, we're getting a bid offer on economic data. I like that. I think that
Pete, is. Pete, would you pay $100? I mean, you're an old floor trader from the CME. You were one of those people that used to wait around. I know it. Don't lie to me. Don't say you didn't. But you'd wait around for that commitment of traders report, and you guys would sit there and you go, the commitment of traders. It's almost like going back to Trading Places. You'd wait for that commitment of traders report, and when it came out, all you guys would try to form an opinion. I guarantee you, at best, you were 50-50 when you saw the numbers. At best.
We definitely took a look at the COT report, especially in things like grains and primary markets. Absolutely. And again, it's backwards look. This is the struggle for me with the data. And Victor, you hit on it. They're going to come up with some random normalization of the numbers. You look at the unemployment number we reacted to 2 weeks ago. That's going to get revised 3 more times as the next months come out. And the number we reacted to will end up being revised to a dramatically different spot. And so for me, the great thing about all these economic numbers coming out is we get movement off of them. So it gives me the opportunity to manage or get in on extremes. The market prints there. That's for me, that's the value of them. I think the argument of if you gave it to me, would I be right or wrong? I don't,
So I don't disagree with you, Pete. I completely agree. That is why I love like things
right.
like that. I love binary events because that's exactly what they do. They give us enough volatility to make the event tradable, but not because we know what direction it's going to go, just because we've increased the level of noise.
Right. Absolutely. And it's also what it does too, especially when you get markets at new levels, it shows you where is that weaker hand sitting. Is it on the short side? Is it on the long side? Those are the kind of, and either we'll have, a spike of a point or two in the bonds on a weak non-farm number and it comes off. And that tells you that, okay, the market wasn't overly short. But if it rallies to 2 points, breaks 2 ticks and rallies another handle, there's some, there's some shorts whose will is getting tested a little bit. So that is what I gained from that information. I have a really hard time building out. I think the last 2 weeks is a perfect example. Look at the reaction we had where after that non-farm number, and then look at the correction we had leading into it and the retail sales numbers, all of which are small subsets of information that are backward looking. I mean, the COT report was actually positions, Tom, came out Friday afternoon at 2:00. You're right. It was Tuesday's position. So you're already missing 4 days of activity. So what's that going to tell you? They're pieces.
I understand. Yeah. I understand, Pete. I was just using it as, I was just giving you an example of something that, it's not an easy thing. It honestly took me almost 15 years of standing in the pits to recognize this. It wasn't until we watched our like 100th, Fed speak come out on Fed adjustment to rates come out or Fed rate adjustment that I finally conceded. Oh my God, none of this means anything. Yeah, it took a long time.
Right. No, it does. And for us, it was great because you were close to the order flow. Number would hit on the screen, and you were able to, we were all able to move quickly. So that was of benefit. But trying to guess that, I think the trade balance is going to be this, so I'm going to go into this number long 200 euros. Is a roll of the dice because it's just it's a random. I just think what we saw the last 2 weeks is a textbook case of why leaning too hard on these and trying to build a consensus picture is really tough. I would rather let the tape. Yeah, I'd rather let the tape actually tell me the state of where we are in terms of is the economy slower than we expect. I think the tape action will tell you that far before the appropriate number of non-farm prints where we see payrolls decline and the rate increase. The tape will have already reflected that, I think. So it's kind of the way.
We're in this environment, to your point, that the macro narrative is so schizophrenic. To your point, you had softness, then you get a retail sales report, 7,000 less claims, and a decent Walmart number, and we're rocking again. So I agree with you. And then we go from, begging for 75% basis point cuts, emergency cuts, to the market completely pricing out 50 basis points in September. We're back down to the likelihood is 25 basis points. So I do think the narrative is all over the place. Trade what's in front of your screen. Speaking of that, what do you think about 2s, 10s, and 30s here?
You know what? We got to, on that Monday, we got down to 3.5 basis points of inversion, and we're back out to 17. So I still have my 2s, 10s on. And I think if you wanted to, if you're looking that at some point we're going to see this normalize in some fashion, this is the last cog that hasn't quote unquote normalized, rates are back to a more normal level. It's this term structure piece that isn't. 17, 18 basis points is a nice place to kind of reload for a run back through zero. And it tends that they don't, when they do go through zero, they don't go from 5 to 3 to 0 and through. They tend to take a running start at it and kind of blow through it. They did that on the way up, and I imagine they're going to do so on the way down. So I still like the trade. I think this is something I'm sitting on that I think has the potential. We're going to see this unwind at some point, and that is, it's a nice opportunity. What we got was the ability. Twos have pulled back dramatically since we had that weak unemployment level. Twos have almost retraced, a big chunk of that up move. If you're looking to add some long twos, it's a nice spot to do so. And then you can leg them either selling notes against them, or you can even go out and sell some bonds against them. You do those 4-to-1 versus the 2-to-1 with the notes. But I think either one of those trades, and that lets you trade the range a little bit. I think bonds continue to exhibit anything north of 124.5 to 125 is kind of the upper end of the range. And until the tape tells me otherwise, I'm going to use that as a place to add some short deltas. And on dips like we're seeing now in the twos, I'm going to pick up some of where I think the value on the curve is, are these 2 years.
Tom, what do you think about the long end of the curve? I think you've been saying that that's sort of a dead, or sort of a dead trade in your opinion.
Yeah,
I mean, pick one direction or the other. Would you lean long or short as we approach 125?
I'd lean short only because I think they're a little bit rich, but I'm not short right now. I have been actually doing the exact opposite. I have been buying every single dip, and it's actually been working for the last couple of months. I haven't been short since, I want to say, probably January. I think I've been long. I've been trading bonds from the long side for this entire year, and it's worked. And only because I thought they got way too oversold, when they got down under 110 and notes got down under 110 as well. I just felt like, there was way too much pessimism, way too much bearishness, and price only. I wasn't thinking about it in a big picture or anything, just price. I thought we got too cheap. Right. I've been buying every dip now, every time they go down a couple of points, and so far it's continued to work. I probably, if I had to choose, gun to my head, I would choose the short side because like Pete said, I think at 125, they're just under 124 right now. So right. I would wait a little bit, and then at 125, I kind of like the short side, but it's not that interesting a trade for me directionally. Like if you said, hey, you got to sell something here, would you rather sell stocks or bonds? I mean, I would sell stocks 10 times in a row before I would sell bonds. The bonds are very one-dimensional. The stocks have a lot more optionality to them. There's a lot more stuff going on. And so I like them much better.
Yeah. And we had a big dollar move last week too. Euro above 110. We're near year-to-date highs of, I think in futures is around 110.65. Yeah. 110.70, cable back to 130. Even Aussie and Canada, which could not get out of their own way, had nice rallies Friday, and they're holding on to the bulk of those gains too. And you saw the yen rally. It was really dollar selling. It wasn't risk off, risk on, where the yen rallied and everything else collapsed. It was just a general dollar selling. And now we're getting into some interesting levels to see. Do we push north of 111 or 112 in euro? Do we get a solid print above 130 in cable? Vols getting a little bit bigger up there. I think those were really kind of, what I like about that is we're getting the levels we haven't seen in a long time. What that means is typically we see vol expand a little bit and we get bigger ranges to trade, and we'll get some back and forth, which is really what I'm looking for there. I think that becomes a really interesting place to see how it shakes out this week. Victor, we've got the head of the Fed speaking on Friday. What is your takeaway? Is that going to resonate or be the usual cutting of the cake down the middle?
I wish I could tune it all out at this point. Yeah. Honestly, it's all. I mean,
thank God we're making progress. We're making progress.
Well, no, I think it's all guiding. It's all guiding forward space. So it's all. it's all reflexive. So we have to think a certain way and see the world through a certain lens, and that's what Jackson Hole is. And I'm sure Ilya will have some thoughts, so I won't drone on too much. You got minutes on Wednesday. You got Bostic talking, I think another one on Monday, and then of course Jerome Powell at Jackson Hole, on Friday. But honestly, man, I just wish I could tune all that stuff out at this point.
Yeah, and you know what? I think the rally we saw, especially on the NASDAQ side, caught me off guard. I leaned in to be a little short too soon, and that was a painful exercise. But the pace at which we've regained these levels, it's got to be, from, as Tom, you like to say, from just a pot-on standpoint, the usual suspects, NVIDIA, Meta, look interesting to short here. NASDAQ, absolutely. And I do think, you know what, if you want to be short, NASDAQ. I didn't stick to, you had an opportunity to buy Russell earlier in the week cheap. I sold the NASDAQ and I didn't buy the Russell. I was getting cheap and I was trying to find it cheaper. So I never got that part of the leg on. Because if you had gotten that on,
it wouldn't help you that much, Pete. The NASDAQ blew away the Russell this week.
Mm-hmm. Yeah.
Hey, we got to go, Pete. We got to run.
Real quick.
Guys.
One more. Gold silver ratio. You had a great call out last week. Yeah. You had mentioned the gold silver ratio was getting to 90. Silver played a little bit of catch up. Your thoughts on that trade going into the week?
It does. And you know what? We're through lifetime highs here. We're off a little bit from they goosed the market right at the end up to 25.50. I think we continue to see silver and copper benefit from this. So at some point, gold will be an interesting sale at some point up here. But I think if we hold on to these levels for a couple of days, the chances the pain will be put into the upside. So there, I wouldn't mind, if I'm going to sell some gold, I'll buy some silver and copper against it. I think that peaked out, that ratio at about 90-75. We're back below 89 now, but now we're in that fishy level, Vic, of, we can trade down to 85 or back into the 90s again. So I think you got to be selective a little bit about these pairs trades once they do kind of knock off on those extremes.
Cool. Thanks, Pete.
You bet, guys. Have a great night.
Thanks, Pete.
Who do we got next? Ilya back?
You got Ilya.
Our man, Ilya.
So I see we're talking the relevance of macro. What a perfect time.
What's up, Ilya?
I actually completely agree with both Tom and Pete for the record. As I constantly harp, I think trying to predict macro is pointless, and trying to think that predicting macro does anything to trade like specific numbers things, completely pointless. I think the most interesting thing about macro is watching what markets do with the macro to then attempt to understand what are they thinking more generally. So since July, the markets have not liked worse than expected U.S. economic data, and that's a change from everything that happened in the 9-10 months before. I think watching macro in that sense is very relevant.
Why do you not think that there's a chance that is just completely random? I mean, statistically, if you were to look at it, you would have a very hard time distinguishing between what you think is an interpretation of that and what would be a random outcome if you just spun the wheel. So that's, I don't think you can
statistically spin the wheel in this sense because it's not a consistent enough thing. I think it's more like you don't have perfect information. You're looking at the price action and basically just reading the tape and saying the emotional makeup of the market in the context of what's going on is X versus Y, depending on how it behaves relative to data. I don't think it's consistent enough historically to look back and say every single time that the market has done this, it's meant X. It's not that good.
You want to know, Victor, why they do revisions?
Why is that?
So that everybody can be right. That's the only reason they do it. There's no real reason to do revisions, except what it does is it gives every single analyst and every paid economist a reason, a way to say that they were right. That's what I hate about all that stuff. It's just such garbage.
Fair enough. So Ilya, I guess on my radar this week, there's the 30-year mortgage and applications. I think there's existing home sales, new home sales on Friday. I think as a tradable instrument, I'm going to make this actionable, Tom. Yes. I'm looking at the home builders. ITB, I think, has exhibited relative weakness relative to the overall markets. I'm fading it. So that includes stuff like Toll Brothers, which has earnings this week, which will also be, I think, a tradable instrument here. But KB Homes, Pulte, and a handful of others. So anyways, my focus into the back end of the week especially is going to be some of the home builders. I'm curious, what do you have your eyes on this week as tradable instruments against the macro backdrop?
So in my mind, all of the kind of minor second-tier macro data is completely meaningless in this environment, because what the market cares about is the big picture. So for me, the numbers this week that matter, first of all, it's the FOMC minutes. That will matter. Because people are going to want to see where the Fed's head was at when they came out last time and said our risks are now balanced. Now we're not only worried that inflation is going to be too high, now we're also in about equal measure for the first time in years worried unemployment might get too high. That, I think, is really the reason we had the sell-off starting in the beginning of July, was the Fed came out and made the thing immediate. It wasn't some future rate cuts at some point, maintenance, whatever. It was, okay, we care about unemployment now. And that, I think, is important. So what kind of a discussion gave us that, where the kind of head change came, and why the markets then got that cue from the Fed, I think that's important. So I'm watching that. I'm also going to be very interested in the global PMI's data set, because that'll be a kind of timely, where are we on global growth in all of the big economies. All of the world's economic data has been disappointing, or tending more towards disappointment since about mid-April or so. That's Europe, emerging markets, except Latin America, everywhere. China, US, UK, one after the other, Australia, Japan. So as you look at all of that, you'll get a sense of where are we in the business cycle and why all these central banks are suddenly rushing to cut. Last week, we had a surprise one in New Zealand, for example. So it'll be interesting to watch kind of what the pace is. And then I think after that, everybody's watching Jackson Hole. I think everybody wants to hear what Powell is going to say as a lens calibrating exercise. They basically want to know if they're operating in the world where the Fed still thinks the landing is going to be soft, or if the Fed is in earnest now concerned about the economy and thinks maybe we over-tightened. That, I think, is everything, I think, will basically fall into a bucket of risk on or risk off, give or take, around those things.
How do you lean going into the week? What are the instruments you lean into?
So I think last week's rebound was obviously very violent. It was actually the best week for stock markets since 2022, I want to say, about third quarter, fourth quarter, October, maybe, if memory serves. I think that mirrored the violence of the sell-off. I think it's no secret that rallies in bear markets are very violent. I'm not buying them, but I'm not selling them until they show some weakness. Once they show some weakness, I want to sell them. I'm still long bonds in like the 10-year space, so not quite all the way out through IEF, which is the 7 to 10 average ETF. And then I have short oil as well. That's been working a little. I still have that. I think the geopolitics will continue to filter out of that. So it's starting to come down a little bit, and that's helping my cause here. I want to be short NASDAQ most of all, as far as the indexes. I think that looks the weakest, but I want to see it start to go there. I don't want to attempt to fight it against this level of violent uptick.
Real quick, Tom, what are your thoughts on crude oil at 75?
I have a very small position on in there. Um, I have been trading it from the short strangle side, so it's been actually coming in a little bit the last couple of days. Uh, I don't. I'm at the one standard deviation expected move. I recentered on Friday, so I mean, I'm not bullish on crude oil. Let's put it that way. I'm not bullish at all. I think crude oil has a better chance of getting into the mid 60s than it does getting into the mid 80s. So I'm pretty bearish on crude oil overall, but I'm not playing it. I'm not short deltas in there. I'm actually delta. I'm looking at it right now. I'm delta neutral. So I'm just staying on the short premium side. I actually don't think there's a great trade in crude oil right now. I think there's so many more interesting. Again, you have to in in the world of trading that like I like to sometimes you have to bucket things, and where there's the most noise and there's the most price extreme. I think this is kind of what Pete said. And it's a little bit what Ilya just said. Like the reason he said the NASDAQ's the most attractive, not because the NASDAQ has been weak at all, but because the NASDAQ, I want to say over the last, the S&Ps have been up for the last, whatever, 7 days. I think the NASDAQ's been up for the last 8 days. Well, including tonight, it's 8 straight days. But the size of the move, percentage-wise, is even greater than the S&Ps. I think that's what makes, the noise around the NASDAQ makes it a really interesting play. And I think if you had that kind of price extreme anywhere, that would make, that makes things more interesting to me. So it's not really what I think about crude oil. If there was more noise around crude oil, I'd be more interested. But given the level of noise, old floor traders always gravitate towards noise, because where there's noise, there's opportunity. And I think that's the way I look at this market all the time. And wherever there's the most noise, that's where I usually end up. And there's the most noise in the equity marketplace right now. I don't sense a lot of noise. There's a few commodities, but not much. I don't sense a lot of noise anywhere outside of the equities, but the equities have plenty. There's plenty of stuff to do.
So let's play a little game then. If we're talking about noise,
Yeah.
last week, PBW, which is the clean energy ETF, was up 5%, which is the complete reversal of the week before. It was one of the underperformers. That includes stuff like Tesla, Albemarle, and all that other stuff. We were just talking about energy, so I'm going to flip it because Tesla's been on a sick little heater over, the last week or so. At 216, where Tesla is, off the lows in the near 180s. What do you think about Tesla here? Fade, or it's not cheap enough? Or it's not good enough.
Fade.
Yeah.
I don't like Tesla here. I'm a little tiny bit short Tesla. I would like to be more short Tesla, but I think things like the chip stocks are richer on a percentage basis. I think they're a little richer than Tesla. And I think Tesla got maybe a little bit more oversold than some of the other stocks. So I do like other shorts better than Tesla. Like I like NVIDIA, I like Meta, I like Netflix. I think there's a lot of really interesting shorts. I like Apple up here. A lot of the big seven. Tesla would be further down the line, but I'm definitely like it from the short side more than I like it from the long side. I mean, I think betting on usually when you bet on stocks, there's more to it than they don't really have a single point of failure per se. Most of the big stocks, like I don't look at Apple and think of Tim Cook as a single point of failure. I don't look at NVIDIA and think of the CEO or the same thing for Meta or something else. I don't think of those stocks as having kind of like a single point of failure that's not, embedded in the stock price. But when I think about Tesla, I feel like Elon at any time is a legit single point of failure risk. And so I don't think it's an interesting stock to me from the long side really ever now.
I agree. I got a whole laundry list of things I want to ask you the same question. Like Palantir hit 52-week highs. There's this company EBS, which is the monkeypox vaccine. Boeing had a nice lift last week. I could spend the next 20 minutes just going fade or trade with you on like 5, 10, 15 different symbols right now, but I guess we're running out of time. Sorry, Ilya, I stepped on you.
No, I mean that's the reason I'm the most interested in the Nasdaq, because a lot of the constituents of the Nasdaq are the names that Tom just mentioned. I'm not going to get into any individual ones because I don't want to get into any kind of idiosyncratic Tim Cook this or Elon that.
I agree.
It's why I'm saying, you know what, the most attractive short for me here is the NASDAQ, because the rally over the last 9-10 months has been mainly that. And so that's the thing to short.
Yeah. Then there's all the questions I want to ask you guys about, price controls and price gouging and the DNC, but I don't want to lose half the viewers, so I'll do this instead. Tom, any last parting words for the Tasty Trade audience?
I'm going to be I think it's going to be actually, my parting words for this week are, I'm going to lean short. I've already sold a few futures tonight, up around here, 87, 90, and 86 in that range. But I went home a little bit short too. I think it's going to be a super whippy week. Like, what that means is, like I mentioned earlier, it's a 5-week expiration cycle. I think you're going to see up 20, down 20 in the S&Ps, which is nothing. It's a 1/3% move. I think you're going to see it all day long. I think they're going to move around, 10 or 20 handles on nothing, on air. I just think there's a lot more risk of the velocity of risk is to the downside, in my opinion, right here, not to the upside. I think the upside has limited risk because I don't think you're going to see volatility. Maybe it gets into the low 14s. So you got 5-7% potential downside in volatility, but you got easy 10 or 20% upside. So I like the downside of this market here for a trade. And I also think you just trade them. It's going to be a good scalpers week. Stay small. I'm going to stay small, lean short, and that's it.
Right on. Do us a favor, everybody. Easiest way to support the content is hit the like button before you get out of here. Easiest way to support all the content creators and the business behind it is to subscribe to the channel. I'm Victor Jones for Ilias Bivek, Tom Sosnoff. Thanks. Tom, take us out, man.
Thanks, everybody. Can't wait for this week. It's going to be a lot of fun. Thanks, Ilya.
Thank you.
Thanks, Pete. Thanks, Vic.